Hey everyone, welcome back to Corporate Decoder, the place where we really dig into the money moves of big companies. And today we're looking at Franklin Wireless Corp. Their latest report is a bit of a mixed bag, some surprising ups and downs that we need to decode. So buckle up because we're about to unpack the numbers before we dive in. If you love getting these unfiltered looks at company financials, hit that subscribe button. And for a deeper community discussion, join us on Discord. The link is in the description below. Let's get started. Alright, so we're looking at Franklin Wireless Corp and their quarterly report, which gives us a snapshot of their financial health for the period ending the 31st of December 2025. Think of it like a doctor's checkup for the company's money situation. First up, let's check out their balance sheet. This is where we see what the company owns and what it owes. As of the 31st of December 2025, they had about $9.3 million in cash and cash equivalents. That is down from about $14.7 million back on the 30th of June 2025. So they're spending cash, but they still have a decent amount sitting around. They also had over $24 million in short-term investments. This is money they can quickly turn into cash if they need it. It's a good chunk of change, showing they are managing their extra cash wisely. Now this is interesting, their accounts receivable, what customers owe them, jumped significantly from $1.3 million to over $10.3 million. This means they've made a lot more sales on credit recently. That can be good, but it also means they are waiting on more money from customers. Looking at their current liabilities, which are debts due within a year, they're at about $13.9 million, up from roughly $12.4 million. So their immediate debts have grown a bit, which makes sense if sales have increased, and overall their total stockholders' equity, which is basically what the owners have left after you subtract the debts from the assets, stands at over $38 million. That is a good number, showing the company is building value for its shareholders. Now, let's move on to how they actually made money, or lost it. This is the income statement. This is the big one. Net sales for the 3 months ending the 31st of December 2025 were about $11.9 million. That is a pretty big drop from the same period last year when they had over $17.8 million in sales. That is a decrease of over 33%. So fewer sales are coming in. Because sales dropped, their gross profit, which is what is left after you pay for the cost of making the products, also went down. It fell to about $2 million from over $3.2 million. That is a nearly 38% decrease. And with lower sales and profits, their income from operations, which is the profit from their core business before other income and expenses took a hit. It dropped from over $795,000 to just about $48,000. That's a huge 94% fall. They also saw a pretty significant loss from foreign currency transactions. For the 3 months ending the 31st of December 2025, this loss was over $192,000. That is better than last year's almost $1 million loss in this area, but it is still a drag on their profits. The bottom line here is that for the 3 months ending the 31st of December 2025, they reported a net income attributable to the parent company of over $533,000. That sounds good, but it's lower than the nearly $229,000 they made in the same period last year. So, while they are profitable, the profit is smaller. Looking at the statement of stockholders' equity tells us how the ownership value changed. As of the 31st of December 2025, their total stockholders' equity was over $38.2 million. What is interesting here is that they paid out a dividend of nearly $471,000 in the period ending the 31st of December 2025. This means they are returning some cash to their shareholders. That is usually a positive sign, showing confidence in their financial stability. Now, for the cash flow statement, this is crucial because it shows where the cash actually came from and where it went. For the 6 months ending the 31st of December 2025, they used over $5.5 million in cash from their normal business operations. This is a big change from the same period in 2024, when they actually brought in over $5.4 million from operations. This negative cash flow from operations is a red flag. It means their day-to-day business is burning through cash. A big reason for this was a massive increase in accounts receivable, meaning customers owe them a lot more money. This jump was over $9 million. So while sales might be happening, the cash from those sales is not yet in hand. On the flip side, they brought in over $704,000 from investing activities. This mainly came from selling short-term investments. So they're tapping into their investment reserves to help offset the cash crunch from operations. And in financing activities, they used over $471,000, largely due to that dividend payment we saw earlier. All of this led to a net decrease in their cash and cash equivalents of over $5.3 million for the 6-month period. So their cash balance is shrinking. Diving into the notes, we see they include their subsidiaries Franklin Technology Inc., or FDI, and Sigbeat Inc. They also report on non-controlling interest, which is the portion of ownership in their subsidiaries that they don't own fully. For FDI, the non-controlling interest decreased significantly, which is linked to FDI's net loss for the period. For Sigbeat, there was an increase in non-controlling interest due to Sigbeat's net income. This shows how the performance of their subsidiaries impacts the overall financial picture. They identify as having one reportable segment, the sale of wireless access products. They generate revenue from two geographic areas, North America and Asia. Looking at sales by region, North America still makes up almost all their sales, around $11.9 million for the 3 months ending the 31st of December, 2025. This is down from nearly $17.8 million in the same period last year, showing a significant decline in their main market. Let's quickly look at their intangible assets. These are things like patents and software that have value but no physical form. They list certifications and licenses as a major intangible asset valued at over $518,000 net. Amortization expenses for these intangible assets are spread out over several years, with significant amounts expected in fiscal year 2026 and 2027. Now, for the liabilities and potential future problems. A big one is a lawsuit in Korea involving their subsidiary FTI. They are being sued by Patron Company Limited for over $8.8 million. The claim is about FTI allegedly using Patron's confidential information and then not buying components they had ordered. This is a serious legal matter that could impact their finances. There is also ongoing fallout from a prior lawsuit concerning short swing profits. Their CEO, O.C. Kim, owes the company a remaining balance of nearly $662,000 from a settlement. This is linked to a forbearance agreement where he deferred this payment in exchange for deferring a bonus. Looking at how they reward their employees, they have a stock option plan. As of the 31st of December 2025, they have about 147,000 stock options outstanding. The weighted average exercise price is around $3.38 per S-hair, with an average remaining life of less than a year. It seems like fewer options are currently outstanding compared to the previous year, suggesting maybe fewer grants or more expiries. Okay, let's get into management's own explanation of what is going on. This is where they tell the story behind the numbers. Management confirms that net sales decreased by over 33% for the 3-month period. They attribute this to decreased demand from their major carrier customers. They also mention an increase in sales to Asia, though the actual amount is very small. They explain the drop in gross profit by pointing to the decrease in net sales and a shift in the mix of products sold, with a move towards lower margin items. Operating expenses did decrease overall, mainly because of lower legal fees and stock-based compensation expenses. Research and development costs also went down, which they say is due to the cyclical nature of R&D projects. The increase in other income is credited to lower foreign exchange losses and a gain from debt forgiveness, meaning some of their payables were essentially written off as income. Now, let's talk about their cash situation. They used over $5.5 million in cash from operations for the 6 months ending the 31st of December. 2025 management attributes this largely to a big jump in accounts receivable. This is a key point. They are invoicing customers but not collecting the cash quickly. Investing activities provided over $704,000, mainly from selling investments. And financing activities used over $471,000, primarily for that dividend payment. Management states their principal source of liquidity is their cash and short-term investments, totaling over $33.6 million. They believe they have enough to operate for at least a year. However, the negative operating cash flow is a concern. They also remind us of the risks. One notable risk they highlight is shortages of components, like memory chips, which can disrupt their production and hurt customer relationships. This is a real concern in today's tech manufacturing world. So, what is the verdict on Franklin Wireless Corp on the positive side? They are still profitable on a net income basis and they are paying dividends, which shows some financial strength. They also have a healthy amount of cash and investments readily available. However, the significant drop in net sales and the shift to negative cash flow from operations are serious red flags. A 33% sales decrease is substantial, and relying on investments to cover operational cash shortfalls is not a sustainable long-term strategy. The increase in accounts receivable, while potentially indicating higher sales activity, suggests challenges in collecting that revenue promptly. The ongoing lawsuit in Korea also presents a significant potential financial and operational risk. Looking ahead, their reliance on a few major customers means any dip in demand from them has a big impact. Also, supply chain disruptions for critical components could further squeeze their ability to deliver. They clearly need to find ways to boost sales and improve their cash flow from operations. That is our take on Franklin Wireless Corp. Its latest report, what do you think about these numbers in the company's direction? Let us know in the comments below. If you found this analysis helpful, please give this video a like and subscribe for more corporate deep dives. And don't forget to join the conversation on our Discord server. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.